You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy March Madness Friday, everyone. And speaking of NCAA tournament basketball, today we have a March Madness special for you, and I hope you find it both fun and interesting because I'm excited to go over a bunch of really fun and interesting statistics and comparisons between March Madness and investing your hard-earned retirement dollars. So we're going to try and make this fun, so don't let the word statistics scare you away. But first, as always, a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, CASH stands for Creating Affluent Success and Happiness. And that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So please come back often. Feel free to subscribe on both iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koos and on Instagram at Financial Surgeon. Last but not least, all links, visuals, charts, and other educational resources are always available on our website. But today, and this is, a treat, especially for our iTunes listeners that are listening in your car or on a walk or on a run or at the gym, we are not going to really have any visuals today. Literally, there will be some visuals, but there's no need for them. So there's really no need to go back and look at them, with the exception of one chart, which is just a chart of the history of NCAA basketball, winners, losers, based on statistics and seeding and stuff like that. So it's kind of fun. So if you want to check back and give that a look later on, feel free to do so and check out the YouTube video. So let's go ahead and get started. As always, a few quotes. If you've watched our podcast before, then you know that I'm huge into quotes, and I'm in the middle of reading this book by Annie Duke. She's an author, obviously, because she wrote a book, and I do the audiobook thing, so I'm always listening to books in my car or listening to them on the treadmill. But Annie Duke is the World Series of Poker champion. I believe it was 2014 or 2004, I can't remember. But she has all these wonderful quotes, and what's been interesting to me about her book, and I'm not finished with it yet, is that it's just kind of changed the way that I think about certain things in life, decisions, conversations, because, whenever, the book's called Thinking in Bets, by the way, so obviously she was a poker player, so the whole concept here is that we as humans have a tendency to either A, be very black and white in our thinking when it comes to our decision making, or B, or I should say, and or B, we have a tendency to, when given a choice one way or the other, to be 100% of the way in on one end or the other. So the concept that she tries to teach in this book is the idea that we need to be more objective, and we need to not think so black and white, and we need to think in probabilities and bets, and that everything is a bet. So I've got 3 of her quotes that I'm going to share here today before we get started, which obviously goes right in line with March Madness and bracketology and all that fun stuff. But the first quote says, the more objective we are, the more accurate our beliefs become. And the person who wins bets over the long run is the one with the more accurate beliefs. So that just kind of speaks to everything I just said. The second quote I have here, she says, job and relocation decisions are bets. You don't know what the outcome is going to be. You can't guarantee an outcome. So job and relocation decisions are bets. Sales negotiations and contracts are bets. Buying a house is a bet. Ordering the chicken instead of the steak is a bet. Everything is a bet. You don't know if you go to a restaurant, you don't know unless you've had the steak before, the chicken before, you don't know if the outcome's going to be a good one. So what's the probability that the steak's better? Well, I don't know. I guess that's up to you depending on how much you like steak or chicken. But everything is a bet. We don't know what the outcome's going to be, which leads me to the last quote. And she says, improving decision-making quality is about increasing our chances of good outcomes, not guaranteeing them. So I think that takes us right into the meat of our conversation today, which is to talk about March Madness, the history of March Madness, statistics in terms of which teams have been more likely to win games versus lose games, and then how that relates to the stock market, along with some really, really interesting facts that I think you're going to find interesting as well. and then I'll close out with just kind of bringing everything home and with comparisons. So let's start here. So first of all, for those of you that aren't big basketball fans, or you only pay attention because you've got a bracket, obviously we've got our teams. I'm a big Buckeye fan, went to Ohio State, so of course I'm rooting for Ohio State. Some of us, watch the basketball tournament because our team's playing in it and we want them to win. Some of us just are huge basketball fans, and I wouldn't call myself a huge basketball fan. If Ohio State's not playing, the only reason I'm probably watching is because I filled out a bracket. And there's been a couple years where I didn't even fill out a bracket. Ohio State wasn't in the tournament, so I literally didn't watch almost any of it. It is exciting though. I mean, there's something very energizing about all these games going on at once and these close finishes. And if you know anything about basketball, then you know that the first, call it, I'll say 35 minutes of the game sometime is meaningless. It's the last, call it 4 to 5 minutes, that really matter. But I think that the pools, all the brackets and pools that people put together, the millions probably of pools out there, are what get people really interested. And for those of you that don't understand how this whole thing works, there's 63 games. And the odds of picking a perfect bracket range anywhere from 1 in 128 billion with a B to 1 in 9.2 quintillion, which is insanity, obviously. So back in 1979, the seeding process began, which I was just explaining to my two boys, Karsten and Camden, the other day. And the seeding process, seeding just means ranking. It's a ranking process. And the goal was to keep the best teams from playing each other early and knocking each other out. And if you're curious why they did that, then you just have to follow the money, as my dad always said growing up. When I'd say, "Dad, why is it that there's so many police on the highway at the end of the month?" Because it seems like there's always a lot of police on. He says, "Well, you've got month-end goals, right? Follow the money." So it's the same thing here. TV networks, they don't want the worst teams playing the best teams in the Final Four. They want those to be exciting games, and they want people to watch, and they want their ratings to be up. So that's why they began this whole seeding process. But there's 4 brackets, or I should say 4 sets of brackets, that make up the March Madness tournament. With in each of these sets of brackets or regions, the teams are seeded from 1 to 16, with 1 obviously being the best and 16 being the worst. So let's talk about some probabilities here. First and foremost, before 2018, used to be able to say that no 16th seeded team had ever beaten a number 1 seed. So in other words, no 16th ranked team had ever beaten a 1 seed in history until 2018. Then, a couple years ago, University of Virginia, UVA, comes in. They beat the University of Maryland, and they don't just beat them, they destroy them, 74 to 54. And then sadly, just the very next round, UVA then lost to Kansas, who was ranked 9th. But they were the 16th seed, so it would make sense they would lose to the 9th ranked team. What didn't make a whole lot of sense is that they lost to they beat the number 1 ranked team, which again had never happened in history before. So I don't know that it makes a whole lot of sense that because this happened a couple years ago that now we need to start betting on 16th ranked teams winning a lot. I don't think that's probably going to treat our bracket very well. But obviously, the higher ranked teams are assumed to have better recruiting, coaching, players, athletic ability. Perhaps they play better as a team, among other attributes, but they have had a better winning record over the years, and in their own divisional tournament, by the way, like the Big Ten tournament, Big East, and so on. So they have a better record, and that's why they're seeded high, and that's why the 16th seeded teams barely make it into the tournament. So, but betting on that 16th seeded team again is probably not going to be a great bet. They call it the Cinderella team, if you've heard that phrase before. The Cinderella team is the team that is lower seeded but comes in and does really well for the first, second, maybe even third round of the tournament, but that doesn't happen a lot. And here's the one image for the iTunes listeners. If you want to go onto our YouTube page, I'm trying to look at my time here. Okay, it looks like I've been recording for about almost 9 minutes. So if you go to about the 9 or 10 minute mark on YouTube, you can jump right to this chart. And what we're looking at here is the NCAA men's college basketball tournament win-loss record, round by round, based on their ranking going back to 1985. So understanding that obviously in 2019 there wasn't a tournament at all due to COVID. So but when you go back here, you can see here that the number one seed has had obviously the highest winning percentage at 79, almost 80%. And when you look down at the 16th rated team, we just talked about how the 16th seeded teams only won a game once ever. So that's a 0.71% win rate, which is not very good. And when you kind of get into the middle here, so 1 to 16, we'll just throw it number 8 right in the middle. The 8th ranked teams only have a winning percentage of about 41.35%. So if you want to look at this and analyze it and nerd out on NCAA win percentages by each individual ranking as well as each round, feel free to fire away. I'm going to move on though and talk about some of the details of these charts or these statistics that I find really interesting. And a lot of this data, by the way, I've pulled from Dorsey, Wright & Associates. So thanks to Tommy Dorsey, my good friend for years, who started Dorsey Wright back in, long time ago, point and figure relative strength based investing, and kind of drew these conclusions years ago, and I kind of latched onto them and thought it was so interesting. So here we go. So the number one seeded teams, the number one ranked teams in the NCAA tournament, March Madness, have won the highest percentage of games, of course, again, at 79.9%. The top 3 teams have a record, if you add them all up, they have a record of 1,025 wins and 378 losses, or in other words, a winning rate of 73.19%. You compare that top 3, again, top 3 teams, 1,025 wins versus 378 losses. The bottom 3 seeded teams have a combined win rate of just 33 games, or 7.28 if you add them up. The top 5, if we expand that from top 3 to top 5, the top 5 seeded teams have produced a win rate of 68.21%, while the bottom 5 teams have won just 16.67% of their games. And the top seeded teams, this is where things get a little crazy here, the top seeded teams have won more games than the bottom seeded teams have even played. So the top seeded teams have won more games. In other words, 455 games won for the top seeded teams versus 441 total games played, which is a pretty amazing statistic, I think. So let's go ahead and tie this together with the stock market with some statistics that I got from Michael Batnick. He wrote this article just recently, a couple weeks ago, and I just thought it was great. Some of these statistics are just so mind-blowing when you really let them soak in. And the first one goes like this. Since 1916, the Dow has made new all-time highs, less than 5% of all days traded, but it's up 25,568% over that same time, which means that 95% of the time the market's in a state of drawdown. Here's another one. The Dow has been positive only 52% of all days that it's traded, with an average daily return of 0.73% when it's up and a loss of 0.76% when it's down. So if that doesn't speak to compounding interest and sequence of returns, I don't know what does. But those are the facts. The Dow's been positive 52% of all days it's traded, and when it's up, its average daily return is 0.73, and when it's down, its average is 0.76%, a loss. The next one, here we go. The Dow has spent more time in a state of drawdown equivalent to 40% below the highs or more than it's been within 2% of the highs. Let that soak in for a second. For the entire decade, during the 1970s, the Dow went up 38 points. That's it. Just 38 points in 10 years. At the low in March of 2009, so after the mortgage crisis, when the real estate crisis began, so at the low of the stock market in March of 2009, the stock market was back to where it was in 1996, same value. Furthermore, at that same low of March of 2009, Japanese stocks were back to where they were in 1980. And then at the bottom, again, that same bottom of March of 2009, long-term U.S. Treasuries, government bonds, outperformed the stock market over the prior 40 years. Just interesting stuff, super interesting. Then over the last 20 years, this is where things get interesting. We can play with numbers, but over the last 20 years, gold is up 340% versus the stock market, which is up only 208%, and that includes dividends, by the way. So it's not like dividends were omitted here, but you can change these numbers if you want. And for instance, we could compare gold to inflation, and since 1980, gold's up 153%, but inflation's up 230%, which means in real dollars, you've actually lost money in that case. And if you had invested from 1960 to 1980 and beaten the market by 5% each and every year, you would have made less money than if you had invested from 1980 to 2000 and underperformed the market by 5% per year. Let me repeat that one. If you had invested from 1960 to 1980, 20 years, from 1960 to 1980, and you beat the market by 5% per year, you'd have made less money than if you had invested from 1980 to 2000, 20 years also, and underperformed the market by 5% during that 20-year period. So what that kind of teaches us is a lot of our investment success has a lot to do with when we were born, because when we were born determines when we go to work, and when we go to work determines when we can save money, and when we start saving money and when we retire is all depend on when we were born, right? So it's some of this, I hate to say, is we have to save, right? I always say that saving and retirement planning is a marathon, and that we have to put one foot in front of the other, and that the market is like the wind. And if you've ever run a 5K, a half marathon, quarter marathon, or a marathon, then you know that even a 10-mile breeze in your face is horrible. It sucks. So but it matters, right? So if you've got the wind at your back, it's the best thing in the world when you're running. So while the market can help us and hurt us when we're in that marathon toward retirement and beyond to make sure we never run out of money in retirement, what really matters at the end of the day is when we're in that accumulation phase of life and we're saving while we're working between now and retirement, is putting one foot in front of the other, which is saving, so that we can get to the finish line. There's going to be wind that blows in our face. Those are bad years for the market. There's going to be perhaps even thunderstorms and rain, which make it horrible. And in some cases, if there's tornadoes, of course, we probably should just get off the get off the course. But my point is that when you're saving for retirement, the most important thing is not what the stock market does. The most important thing is saving as much as you possibly can, while at the same time, of course, living a good life. You don't want to save so much that you aren't enjoying life, of course, while you're living. And then understanding that a good portion of how much success you have in the stock market has to do with when you were born, which is completely out of your control. So we need to focus on what you can control, not the things you can't, of course. And then when you are retired and when you start crossing that river and you're going from your accumulation phase, which is your working phase of life, to your distribution phase, which is the phase of life where you retire and now you start paying yourself a paycheck. It's at that point that, as opposed to your contribution rate to your retirement, that's the most important, and putting one foot in front of the other. What matters now is it's almost like you're walking, I don't want to say you're walking backwards, I'm just kind of making this up as I go here, but it's like your distribution rate, or how much you take out of your portfolio, is what matters. In other words, it's how much you spend relative to your income, whether that be from part-time income, if you're not working part-time, your pension income, if you don't have a pension, your Social Security income. So whatever your income is, that gap that we need to fill between what you need and what you have from an income standpoint, that's like putting one foot in front of the other. That's the marathon from now until the end of your life if you're retired. So, but I digress. I'm kind of going overboard here. I apologize. So, last few stats here. The Dow during the Great Depression lost 17% in 1929. It lost 34% in 1930, the very next year. The year after that, it was down 53%, and the year after that, it was down 23%. So 1, 2, 3, 4 years in a row, down 17%, 34%, 53%, and 23%, if that puts things into perspective. We all hope that'll never happen again, but again, I think it's really good perspective. Here's a fun one. I love Warren Buffett. He's great investor, lots of great lessons. He's definitely a smart guy, but sometimes I think it gets annoying when people think, or the public thinks, that he's just this superhero that has this perfect investment record. So Warren Buffett, he's been called the Oracle of Omaha which if that's not divine or Messiah-like, I don't know what is, but he's considered to be one of the best investors, if not the best investor of all time. But get this, he lost 45% of his portfolio value in the 20 months leading up to the dot-com peak in 2000. During that same period, the NASDAQ was up 225%. Now, obviously, we're cherry-picking the NASDAQ here, which was one of the absolute best performers during that time period. But you can pick the Dow, the S&P. It doesn't make a difference. When the market was going up fast and the market was very strong before that dot-com bubble burst, Warren Buffett was down 45% in those 20 months leading up to the top of that bubble. So anyway, and then last year, Dow earnings were cut in half in 1908. So in other words, the companies on the Dow, there's 30 companies on the Dow, and of those 30 companies, if you looked at their earnings, how much money they were making, their earnings were sliced in half in 1908, but the market, the stock market, as in other words, the price of the companies, the share price of the companies in the Dow that year were up 46%. So even though earnings were cut in half in 1908, this index still went up 46%. And what this tells us is that the fundamentals, what the economy does, is not the same thing as the stock market. So we always have to shy away, I think, from comparing what's going on in the economy, jobs reports, unemployment, fundamentals, price to earnings ratios. All those things are not even close to as important as what the price of stocks are doing on a day-to-day, week-to-week, month-to-month basis. So with that all being said, I'm going to close out with the 2021 NCAA bracket. I'm sure that a lot of you listening have put together a bracket yourselves. If you haven't picked your teams, you could be in trouble here. I think it's a little too late at this point, but if you have a bracket, hopefully you picked well. Hopefully you didn't pick too many upsets and too many Cinderella teams. But the way that we invest money at our office is equivalent to investing in the top seeded teams. I always say investing in the playoff teams, because that applies to NHL hockey, it applies to NFL football, it applies to NCAA football, Major League Baseball. We always want to invest. We want to keep our money invested in the strongest teams, the best teams, which are the playoff teams. And in the case of March Madness, you've got all kinds of different teams here. We want our money to be invested in the top seeded teams. Maybe not put all our money into the 4-1 seeds, right? The top 4 number 1 ranked teams, but maybe we want to have our money invested in the top, call it 4 to 6 seeds in each bracket. So that's, call it 20, 25 investments that are diversified across regions, diversified across the conferences that they play in, the size of the schools, their coaches, and so on. So we're still diversified, although we're more concentrated. What we don't want to do is, in my opinion, and what all the studies say, is that staying invested in the strongest stuff is the best way to go when it comes to investing, as opposed to investing your money in every team in the bracket equally, or worse yet, investing money in all the teams that didn't make the brackets. So if we investing money in equally in every team in the NCAA, even those that did not make the bracket. So and then there's going to be times, if we change this analogy, there's going to be times when let's just use the NFL playoffs, the Super Bowl. So there's going to be times when the top ranked teams lose games. Ohio State had a great season right up until the last couple of weeks, and they just started, losing games, and that happens. That doesn't mean they're a bad team; it just means they had a bad streak. Losing a game, having a bad losing streak is not a big deal. It's when you don't make the playoffs anymore that's a problem in our portfolios. Is what I'm saying. So in our investment portfolios, in our we'll call it the brackets of our financial lives, we want to stay invested in the teams that have winning records, that are making the playoffs on a year-to-year basis. And when they don't make the playoffs, or when we start to see something that goes beyond what we would call just a losing streak into a team being a losing team, that's when we need to start cutting bait, and we need to start replacing those teams with other better winning teams. All right. So that's it for today's show. Please feel free to share this episode with your friends and family, and if you would like to discuss your personal situation further, remember you never have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, just head over to our website to schedule something on our calendar. As I always say, there are thousands of podcasts out there. You chose to give ours a listen today, so thank you so much for tuning in. Again, be sure to subscribe on both iTunes and YouTube, and remember, you can sign up at libertaswealth.com to not only get these updates, but also our other screencasts, vlogcasts, videos, articles, and other material that we send out directly sent to your email inbox. Be sure to follow us on Facebook at facebook.com/Libertas Wealth. I'm also on Twitter at Adam Koos and on Instagram at Financial Surgeon. Thank you so much once again for joining us today. I hope you do really well and wish you the best of luck in your brackets, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.